Welcome to episode 12 of Finance and Money Matters. Quite a lot going on this week. It's pretty pivotal in terms of Fed action, in terms of the earnings profile. I was going to dwell a little bit on the euphoric moves in the gold price, but we'll just have a little chat about that and potentially have another much more extended discussion around gold and what one should think about and do with that asset class. We had the CPI numbers out on Friday in the US, despite the government shutdown. But anyway, the September numbers came through at 3%. Good declining figures from rentals, but that is a delayed function. We've also had a fairly controlled level of rises in terms of core services and food. So the tariff element is still yet to feed through. And that was against a 3% year on year versus an expectation of 3.1%. Pretty much, I think, confirms the fact that we're going to see the 25 basis points reduction by the Fed to the 4% level when we see the Fed making its decision on Wednesday. The commentary on gold at this juncture, I would only suggest that a couple of interesting things are coming through. One is that every action has a reaction, and there are consequences to Trump's kind of unilateral decision-making process in terms of tariffs and general views on different countries and perspectives on how different economies should conduct themselves. And I think that's leading largely to central banks accelerating their purchases of gold in order to avoid the US Treasury market. But the reality is that the main concern of a lot of countries is this President Trump's perspective on what he can and can't do with different countries in terms of tariffs, in terms of potential asset freezes. This all started, of course, even before Trump's time in terms of sanctions on Russia. And as countries begin to get concerned about their potential sovereignty being affected by US sanctions, maybe holding gold in their local currency becomes a diversification away from the US. And that's a consequence, I think, of that unilateralism that Trump has really brought in. More on that another time. Let's have a much more deep dive, granular thought around the earnings that are coming up this week. More than 25% of the S&P 500 is going to be reporting on Wednesday and Thursday in the form of Amazon, Meta, Google, Apple, and Microsoft. With those companies reporting, I think it's worthwhile going a little bit granular and thinking about what consensus estimates are looking like, because a lot of people are talking about this bubble that's developing. I agree, but let's, instead of talking in macro terms about the earnings profile, get a little bit more granular in each case. So when we look at Microsoft, to start, consensus, and every time I talk about consensus, CAGR, or compounded annual growth rate, is the 5-year consensus estimates that analysts have out there. And for revenues, that's 14%, which is incredibly strong for a business of this size of Microsoft. Earnings growth at 16%, EBITDA margins at 60%, continues throughout that period. It is therefore trading on a premium valuation of 28 times forward earnings and a free cash flow yield of some 2.4%. It's not cheap in conventional terms, but it's not in bubble territory either. We've got Azure and cloud continuing to growth, and the capital intensity, we'll talk about that when we talk about Google as well. The capital intensity is extreme at this juncture, but it also is a defensive mechanism that keeps, I think, a lot of the competitors out the way and creates a true oligopoly for Google, for Microsoft, and for Amazon in cloud services. And of course, the AI facilitation is just going to add even more to that moat. For Microsoft, Office and gaming continues to grow. The growth rate is pretty much set for a number of years to come and potentially justifies this premium valuation that it's carrying, although it is very much at the high end of historical numbers. Google, CAGR revenues at 11%, earnings growth at 11%, EBITDA margins at 52%. more reasonable valuations of 22 times PE multiple going forward and a 2.5% free cash flow yield. I would put that in the reasonable basket. There is still room for advancement here. It's sitting at more or less the market, if not slightly higher, when you look at it on a price earnings to growth basis. We've got some, as we just discussed, in terms of cloud, they are sitting third behind AWS and Azure, but ultimately still one of those within the oligopoly. Competition is clearly very strong in search, and I think that's actually quite good for them because it keeps the DOJ at bay. And it's becoming very clear that YouTube is playing a major part in the viewership of the younger cohort. And in fact, in many cases, it appears that YouTube is actually passing the growth rates within streaming, including Netflix, who are finding them quite hard to compete against. And we'll talk about it in the case of Meta, but the ad market as well, they dominate. And of course, digital ad depends largely on AI facilitation in order to categorize and focus on the consumer. So moving on to Meta, CAGR of 14%, again, right up there in the mid-teens, earnings growth of some 15%, EBITDA margins even better than Google at 56%. Price earnings forward is 21.5 with a free cash flow yield near a 1.5%. And that's largely to do with the incredible amount of CapEx that they're spending again on their AI facilitation. I would still put that in valuation terms in the reasonable category. And again, trading on a price earnings to growth basis below the S&P 500 index. So certainly still potential room for improvement there. They are, in my opinion, the AI supremo at this juncture. They have, in terms of ad revenue, they're clear beneficiaries of the compute power that allows for pinpointing and targeting of advertising. And it's very clear that across their different properties, Instagram, Facebook, WhatsApp, well, no adverts on WhatsApp as yet, are really being driven home. And when you talk anecdotally to advertisers, they find that the Meta platform is probably the one that delivers the most return in terms of the advertising spend. And when we look at Amazon's CAGR revenues at some 10%, so clearly lower than the marketplace, earnings at 15%, EBITDA margins at 26%, and that's obviously taking on board the merchant platform, which is significantly lower margin. PE at 24 times forward and 2.1% free cash flow yield. Again, relatively reasonable on a PE growth basis versus market. Clearly, AWS is the biggest player, although being caught up quite fast by Azure. Nonetheless, these three will remain, as I mentioned, the oligopoly in this arena for quite some years to come, despite the likes of Oracle making a foray into becoming one of those. But unfortunately, even for an Oracle, the amount of CapEx that's needed to be thrown at this, particularly with further AI facilitation, if you want to break into this group, you're going to have to do a lot more AI and GPU type of investment. And that's coming at very, very significant premium at this juncture. So I think it'll be very difficult for Oracle to really meet its target and vision that it's been portraying to investors in the last few weeks. And of course, I think Amazon has also one major advantage, which is its ad business, which is growing quite rapidly. They are probably the best placed of any company in the world today, understanding the trends, the characteristics of their consumers, and able to really pinpoint and target advertising them. And so they have been growing within the digital advertising arena quite significantly as well. Probably for me, the weakest of the lot is Apple. Apple CAGR is running at 5.5%, so significantly lower than the group so far we've discussed. Earnings growth is 9%, EBITDA margins at 35%. Earnings PE is at 32.5 times next year's earnings, but with a reasonable 3.1% free cash flow yield. This for me is not particularly cheap, and it's sitting at the foothills of bubble territory. Of course, services, which by 2026 is likely, again, according to consensus, is likely to be 27% of revenues, carries an 80% gross margin versus the gross margin for product at around 36%. And services is becoming a bigger part of the play for Apple. And we've always kind of supported that and suggested that there is a re-rating. But I think that's pretty much in the price now. And probably Apple, of this particular group of 5 companies that are now reporting this week, is on a very high pedestal in terms of valuation. Putting it all together, I think that there is still plenty of growth drivers still to come for all of those Mag 5. And obviously we've still got Nvidia, and Tesla has already come through, less impressive. When valuations become quite significantly high, earnings announcements become effectively quite a binary outcome. That leads to significantly higher volatility. So we're going to see potentially any disappointments being punished quite severely with 5% plus type of corrections. I suspect that any results that come through better than expectations, significantly better than whisper number expectations, will probably see a smaller upward move than if they were being punished and going the other way. There's, I suspect, less chance of a re-rating, if you like, going forward from here, given that we've had so much of that. But all of this is largely dependent on the macro. If macro continues to improve, liquidity increase, and interest rates decline, then there is a very simple choice for investors, and that is to continue to buy into this group because they give the biggest and best exposure to market and for growth. And of course, the opposite would occur if we start to see a slowing in the economy, that interest rates start to base out and unemployment begins to increase. Not that we can see any figures for unemployment at this juncture yet, given the government shutdown, but any of those things begin to take liquidity straight out of this group. And largely because passive investing has become such a major part of the investor profile that there are tens, if not hundreds, of ETFs that have significant exposure to these Mag 7 stocks, which means that whenever people want to get further exposure to risk assets, they're buying this passive exposure and getting this significant concentration into the Mag 7. Great when it's moving higher, not so good, and quite detrimental in terms of volatility when it goes the other way. So far, the evidence would not suggest that we're seeing any particular reason why we're basing out in interest rates just yet. Certainly likely to see the 25 basis decline this week, probably another one before year end, and potentially another 50 to 75 basis points, if not more, next year when we have a much more dovish Fed post Jay Powell. So all in all, this week is certainly going to be pretty volatile. I continue to believe that the dips are going to get bought at least until year end. We're not in a cheap market. Valuations on their own have never been the catalyst for market declines. They are post-mortem used as the signal that markets were already way too expensive and needed a correction. I don't think we're there just yet. Have a fantastic week. We'll come back with more stuff. And we're launching, as of this week, our interview series as well, which will hopefully be publishing on Thursday or Friday. And this week, we're going to be talking to a really interesting space fund, which is launching very soon, with some really interesting insights into how space applications are benefiting Earth. Have a great week.